The Standard Deviations podcast is a weekly production that looks at money, mind, and meaning, all through a psychological lens. Each week, psychologist and New York Times bestselling author Dr. Daniel Crosby interviews a fascinating new guest, experts in everything from finance to literature to wellness.
When was the last time you splurged on something when you knew it probably conflicted with one of your financial goals, like paying down debt or saving for future fun in retirement? Well, if you do this, you're not alone. It's because of present bias, or to use the psychobabble term, hyperbolic discounting. As humans, we have a tendency to let the immediate rewards of the here and now win out over a desired future reality. To learn more, check out the Cash Stash Dash, a planning tool brought to you by the Guardian Network to see just how much your short-term spends might be impacting your longer-term financial goals. Play today by visiting www.livingconfidently.com/play. Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. I am joined today by Gregory Zuckerman, who is the author of the critically acclaimed books The Greatest Trade Ever, The Frackers, and is a special writer at the Wall Street Journal. At the Journal, Greg writes about financial firms, personalities, and trades, as well as hedge funds and other investing and business topics. He's a 3-time winner of the Gerald Loeb Award, the highest honor in business journalism. We are here today to talk about his new book. Welcome to the show, Greg.
Hey, great to be here.
So, Greg, you're the author of a number of really fantastic books, but we're here today to talk about your new book, The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. What in particular was it that drew you to Simon's story?
So I'm a veteran Wall Street reporter, and to me, the one story that hadn't been told is how Jim Simons did it. We all kind of know that he's arguably the greatest investor / trader, moneymaker in modern finance. He's got these extraordinary returns, but it hasn't sort of been explained, hasn't been told how he pulled this whole thing off. He's a secretive guy. His firm's quite secretive. So it intrigued me. It was sort of a challenge. And there's also the fact that a lot of my writing is spurred by a paradox. There's always some paradox. I wrote a book called The Greatest Trade Ever, and the paradox there is, how is it that this guy, John Paulson, who was a merger arb, anticipated the financial meltdown? The book, The Frackers, I wrote, is about some outsiders from the oil and gas industry, small fry, kind of colorful characters, and they spurred this revolution, oil and gas fracking revolution, when all the giants gave up on America. And there's a paradox here as well with Jim Simons, and he's a mathematician. He's a guy who didn't really care about business. He hired people not from Wall Street. These aren't people that really cared much about investing for most of their lives, or scientists or mathematicians. And yet they're the ones who figured out how to beat the market. It should have been these Jim Simons and his colleagues. So that was the kind of a paradox that really spurred my interest.
Yeah, it was fascinating reading the book to hear that he really had no business background. He had never taken a course on, how to read a financial statement or anything of the like. And here he is with these eye-popping returns. Going with this theme of secrecy, Rintech is a famously secretive firm. Mr. Simons himself is famously secretive. You begin the book by relating a story of an interviewee saying, "You do know that no one will speak to you, right?" How difficult was it for you to source the information you needed to create such an in-depth portrait?
Yeah, so I have to share that it was the hardest thing I ever did in my life. It really was a difficult process, both getting people to open up and talk. And as you suggest, this is the most secretive firm Wall Street has ever seen. Simons himself early on told me he wasn't going to work with me. He told other people not to work with me, even people that don't work at Renaissance or never worked there, rivals, people, big names that we've all heard of, who help run other firms. And I was just sort of learning about the industry and the quant world and getting their perspective on Jim Simons. And he didn't even want them talking to me about that. So, yeah, for a while, I wasn't sure I could pull this book off. I had a check from the publisher sitting on my desk for months because I didn't want to cash it. Because if I cashed it, I wouldn't be able to give it back. I would start spending it. And I wanted the ability to be able to give it back if I couldn't pull it off. So eventually I broke through. I got enough people to talk. Even Simon sat down and talked with me, but it took months and months before I could get over that fear that I just couldn't make this happen.
Now, is the secrecy driven by a desire to just keep a personal life personal, or is it a fear that the RenTech edge will sort of leak, that the secret sauce will get out? Did you get a sense of what drives this thirst for privacy?
Yeah, it's more the latter. So they have a very unique approach. They believe in being very open and transparent internally. They share everything. It's one of their advantages, I would argue. It's one of the things I've sort of discovered that they do differently than most everyone else. Everyone has access to their code internally and can work on other people's work, improve on it, etc. And it's a real advantage. But as a result, they're paranoid about information getting out. So they don't want any. I mean, there's a firm that has 66% annual returns before fees since 1988. And they realize how ephemeral this thing is, how it can go in a second. And even if they lose a little bit of an edge, I mean, I frankly had a conversation with Jim at one point, and I said to him, Jim, if you laid out all the algorithms in front of me, I wouldn't be able to understand them. And he sort of half laughed and smiled, but wasn't going to lay them out or share too much. So they, even if it's a paranoia on their part, even if it's an overstated concern, they realize that there are a lot of smart, very sophisticated people out there trying to do what they're trying to do. And if they give up a little bit of their edge, then they're done. So they don't want anything leaking out.
Now, did you, after all this depth of research that you did you walk away with any idea of the secret sauce? Did you walk away with any better notion of how specifically they go to market and how they try and slice and dice the equity in other markets?
I did, yeah. So there are, I don't know, a dozen, probably more, significant advantages they have over people. They don't have, I kind of went into this project thinking, okay, maybe they've got some secret that every Tuesday at noon in London trading, this happens every single time and we can make, it's not like that. So what it is though, they have advantages, a good, I'd say 15 or so over others. And it comes from everything from how they clean data, how they deal with their technology that allows them to figure out the risks and the impact, their market impact, how they hire people, how they have this open architecture that I had referenced earlier. They recruit differently, they manage differently, they incentivize their employees differently. So you add all those things up. They use a lot of leverage that other people don't. They've been aggressive with tax benefits. So you add all those things up, and that's where you get the returns. Again, there's no kind of deep secret, but it's also important to remember that they cap their funds, or at least the key medallion ones. So right now it's 10 billion. Earlier in its genesis, it was smaller. That's really important too. So they couldn't have these kind of returns if they were much bigger. Now they manage outside funds that do well, but not quite as good as medallions. So I guess the point being, I do have a much better sense, and I think the reader will too. They'll come away, I think, from the book, from The Man Who Solved the Market, with an understanding of why they're so good, but also with an understanding that they may not, they're not heroes. They're not that much better than everybody else. They're better than everybody else, but they also are pretty modest in their own self-evaluation, because they realize they get it right about 50% of the time, just over 50% of the time. So that keeps you humble.
It's fascinating to think that the secret sauce may not be that secret at all, that it may be sort of unsexy things like hiring practices, the way that people get incentivized. These sorts of things actually represent perhaps an untapped source of alpha for other people who are listening to the show. Everyone wants to focus on perhaps the specific factors, the specific market factors that lead to that kind of performance.
But I think when you read the work of, everything from your book to Ray Dalio's book, you get a sense that the edge of some of these masters of the universe is just as much in the way that they interact with their employees, the sort of openness that they've cultivated internally, as it is anything more specific to capital markets.
And I think that's true. Listen, I don't want to undersell their genius. They do an amazing job of simulating their trades. They know exactly. It's an engineering edge, I would argue, they have over people. They're disciplined in how they run their operations, the sort of blocking and tackling. They don't get headlines, but they're really crucial to any technology company. They trade exactly as they simulate. They don't cheat, as they call it, by looking at data that you can't see in real time, little things like that. But they also have ways to hide their trading, and they've got some creative, innovative approaches there, which I get into a little bit. But more than anything, so I don't want to undersell those little techniques, which are important, but more than anything, as a Renaissance person explained to me, Jim Simon's genius is in managing genius. So his ability to recruit, and he developed that at an early age. Before he got to Wall Street and did any trading, he became a master recruiter in academia. And he also learned how to build algorithms when he was a code breaker. So he had these early skills that he brought to the table. And again, his genius is managing genius, and they really do have genius over there. People talk about hiring PhDs on Wall Street, and everyone says how many PhDs in the quant world they have. The people that work at Renaissance aren't just PhDs. These are the people that are the top of their fields in academia. And somehow Simons and others lure them. They convince them to come and give up the prestige of academia and work in this secretive organization where no one's going to really know how good you are. It's on the one hand, yeah, you say, okay, you're going to make a lot of money, and that's a huge, huge part of it. I don't want to underplay that, but they are giving up a lot by joining Renaissance, and the firm's ability to recruit and continue to lure these types of people gives them a continued advantage.
So one thing that struck me, and indeed it is referenced in the subtitle of your book, is just how revolutionary the quant or algorithmic approach was at the time, which was otherwise the heyday of high-touch discretionary investors, folks like Peter Lynch and Warren Buffett. Can you talk about maybe the landscape, the investment landscape when Jim Simons lands on the scene, and how thoroughly he's transformed that landscape?
Yeah, that's a really good point. I'll first take a step back, and I don't think people appreciate how long it took for Jim Simons to turn the corner and make it happen as a quant. So he only started trading full time around the age of 40. In the late 70s, he started getting excited about it. And as I describe in my book, he took years to really arrive at a quantitative approach and settle on the right approach. For a while, he tried models. They didn't work. He shifted to more traditional investing, like I would, or maybe you would, betting on trends in the market. He made some money, lost some money. It literally left him sick to the stomach. Some days he'd feel like a genius, other days like a fool. And there was for over a decade, back and forth. He had different people working with him, mathematical stars in their own right, and they didn't always pan out. They left in acrimony. There were problems dealing with them. Some of these characters, they were fascinating and colorful in their own right, and super smart and accomplished, but sometimes they didn't work so well with Jim. So they only really turned the corner, I would argue, I argue my book, around 1990, when they settle on more of a short-term approach. And it's important to remember these guys at Renaissance, Jim Simons, they're not high frequency. They, on average, hold their positions about 2 days. They will get in and out quicker than that, but a lot of that is just placing trades. Sometimes they'll break up the trades and it looks like it's high frequency, but it's not. So as you suggest, they turned the corner around 1990. Then in the early 1990s, they started perfecting their approach. Really, 1996 was the key moment, I would argue, where they started figuring out equities. Until then, it was really just on the future side. But while they were doing that, there was the heyday for people like George Soros and Stanley Druckenmiller. They did in 1992, they They, using instincts and intuition and judgment, they bet against the British pound, and they made what at that time was the greatest trade ever. You had people like Peter Lynch, as you suggested, at Fidelity, making a fortune by doing things like talking to management. And Jim Simons and his approach it was just revolutionary, because they couldn't care less about talking to management. They wouldn't even know what to ask management. They don't know anything about anticipating, predicting, evaluating where revenue were going and earnings and those kind of things. They didn't have a sense for who's a good manager and who's a bad manager. They didn't care about those kind of things. If anything, they thought those approaches that we all use are distractions, and they are looking for patterns. That's their whole thing. And yeah, it was a revolution. And there were a few people like David Shaw and some others trying to do it. And I described some early attempts at quantitative trading. Some worked, some didn't. But they were raising money. Jim Simons was trying to raise money in the early 1990s. And people kind of giggled. People didn't think it was the right approach. And you can understand why. Again, at the time, it seems like folly. It seemed like it didn't make sense to use a computer, to rely on a computer, when you can just use your intelligence and your traditional God-given approach of using judgment and intuition.
Well, one of the reasons why I loved reading the Man Who Solved the Market is, we look at today and we take for granted that things have always been that way. Now the preponderance of trades occur in a systematic, algorithmic way, but it really was revolutionary for its time, and you get a sense of that reading the book. So I turned, again, Simons was about 40 when he started. He had already had a lot of other successes, but was about 40 when he started trying to solve the market, as it were. I turned 40 last week. So if I were to undertake this myself, right, could Simons' success be replicated today, do you think? Could someone jump in now, use the same approach and crack the market the way that he has? Or do you feel like things have shifted?
So it's a good question. On the one hand, in all my books, for whatever reason, the people pulling off the huge home runs are at least 40, usually over 50 years of age. And Simons himself, he started in 1978, but didn't turn the corner till 1990 and mid-90s when he's well over 50. But I would caution today, it's so much harder. And that's partly because they've got this huge, enormous head start. And just for example, in terms of data collection. So today you could collect, it's easier to collect data, to buy the data that you need, but they've got a real head start. They've got stuff from the 1700s and 1800s. Now, do they rely on it all? Not really, not usually. Out of curiosity, though, sometimes they will use it. But it does help inform their trading, and they've got a history of hiring talent and luring talent, and people know them. When you talk to people internally at Renaissance, they don't see themselves as competing necessarily with like Two Sigma or AQR in terms of talent and other. They really just see themselves as competing with Silicon Valley and the Facebooks and the Googles of the world. And that just sort of underscores the challenge in terms of hiring talent that's going to compete with Renaissance. So if you started today and you wanted to hire people, you could get a PhD and you can get a smart PhD, but you're going to get someone who's the top of their field like Renaissance can get. So I'm not suggesting that people throw in the towel. There always are upstarts, and the people internally at Renaissance are scared of these upstarts and nervous about people taking away some of their alpha, but it is hard.
Yeah. So it seems like the information is more readily available perhaps than it was in his time. And of course, with that, there's the accompanying erosion of alpha. So when I read books like this, and when I study the lives of great market wizards like Simons, he was a skilled mathematician, he was a code breaker, he was a professor, all of which you could argue are more important from a societal perspective than someone who's trying to beat the market. Do you feel that trying to beat the market, the way that he applied his big brain, was a productive use of that kind of gift? Or is it a sort of a societal waste of time?
Well, it's not necessarily for me to judge. I do think that there are too many people in the trading world, and some of those brains, which are pretty impressive, could be applied to other things, to curing diseases and improving society. So I'm not sure we do need an efficient market. We do. Capital markets are the backbone of our society. I'm a capitalist, work at the Wall Street Journal. So we do need sharp, smart people in the markets, improving and continuing to make things efficient and flowing, and capital should be flowing in the most efficient way possible. But I'm not sure we need as many brains as have been applied. Now, as far as Simons is concerned, so he's an interesting case because on the one hand, he spent the bulk of his adult life doing either abstract mathematics or trading in the markets. And one can argue that there's not that much societal value. He could be doing other kinds of things. The counter argument is now that he's worth $23 billion, he's among the most impressive philanthropists out there. He does everything from, he's a leading backer of research that's dedicated towards autism and discovery of drugs. And they're making some progress there. It's not clear how much progress there will be, but you do have to give him some credit there. He's excited about drugs in the pipeline. So he's doing things in autism. He subsidizes math and science teachers with $15,000, math and science teachers in New York City, New York State, to keep them from leaving to join firms like Renaissance Technologies. So he is giving back a lot. He's involved in politics. One can argue maybe he should or shouldn't be. Bob Mercer also, his colleague, got involved in politics, and he may be the person most responsible for Donald Trump. So you can argue that maybe one person shouldn't have as much clout as he does, Jim Simons, but much of what he does, especially today, is giving back, and he's very philanthropic. So you can argue that, okay, he spent decades doing things like trading markets, and he's reaping the results, and all those billions now are going back into society.
Yeah, it's always interesting for me to think of someone who's a once in a generation genius like him. You know, certainly he's doing a lot of good, keeping markets efficient, being a generous philanthropist, as you suggested. It would just be a sort of a fascinating counterfactual to see what kind of good he could have done in the world if he had again worked in applied medical sciences or another area. Just fascinating counterfactual consideration. So it's been.
Yeah, I do have to note that now he really is 100% focused on philanthropy, and he's very involved. So he is using that brain to work with scientists, ask them tough questions, to hire the right ones. So at least we are benefiting over the last decade or so from that genius.
Yeah, that's fantastic to hear. So it's been my experience of working with very bright people that the genius in one area often leads to deficits in other areas. As you dug into the particulars of Simon's life, are there parts of his life that aren't as laudatory as his work in investing?
So that is the case for a lot of the people at the firm. I'm not sure laudatory or not, but it is the case that they're not as personable, they're not as outgoing, they're mathematicians, they're scientists, they can be quite difficult to work with. That was part of the challenge of my book writing, that people within the firm, people who worked there previously, and just people who are mathematicians and scientists in that world, maybe someone who I dealt with a lot of people who worked with Simons back in the 60s and 70s, taught with him, etc., did research with him. They're quite difficult personalities. So on the one hand, math and science comes really easy to them, but dealing with others, they're not always as comfortable. They don't always enjoy as much. They have difficulties. They find problems. They nitpick. So in regards to your point, yes, it is the case that if you're somebody who's a super duper quant at Renaissance, you may not necessarily want to have a beer with them. They've got some deficits elsewhere in their life. Jim Simons, though, I have to say, is a pretty unique character because he, in some ways, can do both. He's quite personable. He's a funny guy, self-deprecating, aware of the world outside, politically minded, He early on, I write in my book how he, as a student, after high school, he drove the country with a friend, and they experienced poverty. They got to know all kinds of different types of individuals and communities in our country. Then they drove down south, South America. So he's got an interesting, and those experiences had an effect on him. He became a little more sympathetic, maybe. And I do have to also note that he's gone through tragedy in his personal life. I talk about it in my book. 2 of his children have died, and he's experienced things that no one ever wants to. So despite the successes in the market, the $23 billion he's worth, he's also gone through a lot of difficult time in his life. So, but getting to your point, he is someone who can do both worlds. So, and then that's part of his success. Part of the reason why he is the greatest moneymaker in financial history is because he understands the financial equations. He can put together the algorithms. He understands the math. He's still working on math. And it's important to note that even if he had never even if he had never invested a penny, he'd still be worth writing about because of his math and his code-breaking genius. So he's a really unique character.
Yeah, I've watched his TED Talk, and I found him immensely likable. I found him, as you suggested, funny and sort of an endearing speaker, and very, very likable. And perhaps that is a part of his genius, his ability to straddle both worlds, to be both personable and that brilliant is a rare combination of factors. So
and it's helped him. I just want to make a point that it's helped him recruit. So he's a master recruiter, and not every math genius is able to do that, and that's tapping into those other skills. Exactly.
Yeah. So just last question before we get to sort of a little free association exercise I like to do. Last question would be: has your own personal investing changed at all as a result of the research you did for The Man Who Solved the Market?
Well, at the Wall Street Journal, we have a lot of restrictions on what we can invest, but my perspective on the average investor and their ability to make money in the market has changed, because these people I've written about, and it's not just Jim Simons, it's the people working with him, the scientists, the mathematicians that work there, they're at the top of their field, and they're going to go down in history as the greatest money makers Wall Street has ever seen. And it's hard for them. And they're constantly paranoid and nervous and scared about losing their edge. And they're almost surprised at how well they do sometimes. So if these guys have such difficulty, and again, they get it right barely more than 50% of the time. So to me, on the one hand, you say, oh, wow, these guys are up 66% a year for decades. That must show there are more inefficiencies than one might think in the market. But I would argue the contrary. This shows how few inefficiencies there are, that even these guys have challenges and are nervous about the future. So, and it also underscores how much you need to understand about what impacts stock moves and other kinds of moves. So they are aware of factors. We all have aware of factors, but the impact on investing and on price moves is much greater. There's so many more factors that we're not aware of. And that's one thing that's jumped out, and I learned from the book too. They've got an understanding of more of them than most others, but we still don't quite have a good sense, we as investors, of how things move. Their whole investing credo is that patterns will repeat. And we'll see if that's the case or not, and whether things have changed or not. But the challenges for the average investor really are underscored by my research for my book and by the success of Renaissance and Jim Simons.
Well, I thought it was enormously telling when I was reading your book to see that someone as brilliant as him and the people he surrounded himself with, it took them, a decade plus to get it to where they could get it right more than 50% of the time. I mean, that should be very, very humbling and chastening to the average investor to think that someone with that kind of mind and that kind of commitment to getting this right, it could take them that much time to arrive at 50% plus accuracy. I think indeed it shows you just how efficient markets can be.
Yeah, and that and the fact that they almost gave up. They almost gave up on trying to make equities work. So in 1996, they were managing $800 million in futures, bonds, commodities, currencies, and they were doing well. I don't want to undersell how well they were doing, but they knew they could never get bigger than $800 million without hurting their returns unless they made it work in equities, because you can manage a lot more in AUM in equities. And they spent over a year, it was probably a few years, trying to make equities work, and they threw all their manpower at it, brainiacs, top people from all kinds of areas, and they were frustrated by it. They almost gave up. And even Simons, who's a very upbeat, optimistic, positive guy, he said, guys, I'm going to give you a few more months and that's it. So it almost didn't happen. So even for these, this is a success story, but even they almost didn't make it happen.
Absolutely. So final set of questions. We'll just do, I'm a psychologist. So what would this conversation be without a little free association? I'll throw out a question and just, very brief answer. So your next project.
I've got a screenplay that I've always had in the back burner related to the hedge fund world that I want just for myself get done. I don't know if I'll be able to sell it. I just want to feel like I did the best I could. So let's see. After I'm looking forward to speaking about the man who solved the market and doing touring and getting to meet people. But that's my next project.
Awesome. Simon's lasting legacy.
I think he's going to go down in history as the greatest moneymaker Wall Street has seen, but equally known as a philanthropist. If he can have some success in things like autism, and then he really might be remembered as much as a philanthropist. And he's doing some other really interesting things too. Research on how the universe began, the first few moments of existence. And he's got scientists he's funding all over the world. And it's not just sort of some rich guy who's throwing money at this or go get it, guys. He meets with them. I've talk to the scientists, he pushes them, he discusses with them. This is his passion now. So Simons I'm not guaranteeing it, he might be remembered as much for his philanthropy and his research outside of finance as he will be for finance. But yeah, he's going to go down in history as the greatest trader, I think, we've seen in modern finance history.
It's fascinating. Peter Lynch did a lot of research into spirituality and, the origins of the universe and sort of existential questions. It's interesting to see the kind of big questions these folks start to answer or try to answer when they get financially secure. The last question for you, the best book ever written that you didn't yourself write?
Oh, it's got to be Den of Thieves. Den of Thieves is brilliant, and I continue to read it and reread it. It's in my genre, so it's something of interest to me. But yeah, that's a brilliant book that I hope the man who solved the market, is seen in the same league. Hopefully, is.
Absolutely. So, Greg Zuckerman, thank you for joining us today. People go out, grab the man who solved the market. Greg, if people want to follow you and your work, how can they get in touch with you?
So I'm on Twitter, but I'm also easily available in email. And I love hearing from people, critiques, criticisms, ideas for other projects, stories, the Wall Street Journal, next books, that kind of thing. Hey, you wrote about this. Have you thought about writing something else? Constructive criticism. Send it all to me, gregory.zuckerman@wsj.com, or tweet me, and I'm on Twitter as well.
Okay, thank you so much for joining us today.
Oh, great. That was a lot of fun.
All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by the Guardian Life Insurance Company of America, Guardian, and its affiliates, subsidiaries, employees, and agents, including Park Avenue Securities and the Guardian Network. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information participants consider reliable, and Dr. Crosby and Guardian are not responsible for the consequences of any decisions or actions taken because of the information provided. Guardian copyright is a registered trademark of the Guardian Life Insurance Company of America. All materials are subject to United States copyright laws. Copyright 2020 Guardian. 2019-91520, expiration 12-21.